Good evening. Welcome to the San Mateo County Dental Society webinar. My name is Nesmar Morales. I'm a member of the SMCDS Leadership Council. Mr. Goldman has been practicing law for 38 years with extensive trial experience defending dentists and physicians in malpractice cases, employment matters, licensing boards, and business litigation. In the business law arena, Mr. Goldman handles business transactions for dentists, physicians, and optometrists in preparing practice sale agreements, partnership agreements, associate agreements, and staff employment agreements. The Goldman Law Firm is located in Tiburon, California, and consists of trial attorneys and associates, including Mr. Goldman's daughter, Julia, and son, Andy, both attorneys, all dedicated to keeping doctors out of legal trouble. So live from Tiburon, California, please welcome Ronald Goldman.
Thank you. I like that. So good evening, everyone. It's a pleasure to be here, and I certainly look forward to the time in the near future when we can start appearing personally, and I can see you sitting in chairs, and it's either going to be at a restaurant or at the Dental Society location. I kind of miss that, but this kind of works out well too, because everybody gets to stay at home. And even though I might have a tie and a white, shirt on, you can just imagine I got my jogging shorts on, ready to go for a run. But we're going to run through some good dental law today. I think I'd like to start with my PowerPoint. So if you want to let me take control of that, do I hit my screen share now or in a second?
You can hit it now.
Okay. Okay. So a couple things. As we go through the program tonight, if you have questions, please raise your hand or do whatever you need to do so I can answer your questions, because that really customizes what we're talking about today to situations that you get yourself into. And I use the term youthful dentist. I didn't necessarily want to use young dentist, because there are quite a few folks out there who get into dentistry when they are a little older. So I didn't want to sound discriminatory. But understanding the basics of what goes into legal agreements and kind of some of the business law problems that we see doing the kind of work we do, which is primarily representing dentists in business transactions and malpractice lawsuits and business lawsuits. There's just so much that you kind of need to know. When you graduate from dental school, you are not given an MBA in business law, and you really should be. And unfortunately, with the local schools, just because of cutbacks, we used to appear in front of the graduating seniors for the DDS programs and talk about business law, or come in for some of the residencies, and that just hasn't happened nearly enough, especially because of COVID. So the stakes are just so high in the business aspects of practicing dentistry, the employment side of it, the finance side of it, that you really can't make any missteps along the way. And if you do, they end up being, unfortunately, pretty costly. So let's kind of talk about what I call the top 10 business law pointers. just a bit of an overview of some of the key items here before we get into some specifics. The specifics we're going to be talking about tonight are associate agreements, since I know a lot of you are in that status right now. Buying a dental practice, since a lot of you end up buying a dental practice. Entering into a shared ownership situation for dental practice, such as a partnership or professional corporation, going over that a little bit, and then touching on some employment law as well. So we got a lot of stuff to cover. Once again, I invite your questions. So number one, business agreements should always be in writing. I can't tell you how a couple times a month we get calls from dentists where they say, well, I've been in this practice as an associate for 5 years, and the practice owner and I are, really got along well together. Practice owner said, if anything ever happened to him, I'd be the one he sells the practice to. And we never had it in writing, but it was known that was going to happen. And the practice owner passed away last week, and the spouse has kind of kicked me out of the practice and brought in someone else to take over. And do I have any rights? And unfortunately, the answer is no. If you're going to have an associate agreement and an option to purchase, or a right of first purchase, right of first offer on a practice, it's got to be in writing to be enforceable. We run into the same kind of thing with lease extensions, and that comes to mind because we have one of those that happened this week, where, let's say you own your practice, you have a lease agreement. Typically it's a 5-year lease with 2 5-year options. The options indicate that within a window of time, not less than 90 days, not more than 180 days prior to the end of the term, you have to provide written notice to the landlord that you're extending the lease. Let's say you have a situation where you've got it's a dentist in a dental building who owns the building. You got a great relationship with the person, and you had an oral discussion about extending the lease. He said, "Yeah, sure, let's do it." But you didn't sit on your computer and send them an email to say, pursuant to whatever provision of the lease, I'm extending my lease, exercising my option. Please send me a return email confirming this. You don't get that. And then something happens to the landlord, or the building gets sold. That oral extension of your lease is unenforceable. There are, it's kind of like creating a dental chart. The dental board's position on charting is, if it's not charted, it didn't happen. And in legal circles, if you don't have something in writing, then either it's not enforceable or it's very difficult to enforce. Anything that deals with real estate leases, et cetera, if it's not in writing, is not enforceable. If you have an oral agreement that's not related to real estate, for instance, an associate agreement or some other type of agreement, you can pursue an oral contract as far as a lawsuit goes, but you're just not going to prevail. It's just not worth the money of hiring an attorney to pursue something based on an oral agreement, because you're going to get the other side saying, nope, that wasn't the agreement, and you're not going to prevail. So get things in writing. It's for your protection. Second, assemble your professional team, so you know that you've got people on your side and ready to help. We help a lot of young dentists, younger dentists, youthful dentists who are buying dental practices. And the good practices tend to go pretty fast. So when you have an offer that's accepted on a practice, typically you're going to be in that practice as an owner within 30 to 45 days. So you have a lot to do in a short period of time. You have to have an accountant or practice financial person go over the records and take a look at tax returns and make sure that the practice is as it is represented and can cover your expenses, including a business loan and school loan when you start practicing. Typically, you'd engage an attorney to review the practice sale agreement, to review a new lease or a lease assignment. You need an insurance broker, because you're going to need insurance for workers' comp, for premises liability for your new office, life insurance for the bank that's lending you the money, and disability insurance, which is typically required by the lender as well. So you need all these people, ready to go once you say yes on buying a practice. And you don't want to spend that valuable time looking for these folks once your offer's been accepted. The other thing too is try to stick with people who know what they're doing in the dental field. So often with accountants, it's somebody's brother-in-law or sister-in-law who is an accountant, but they don't do dentists. The accountants who do dental practices, they know what the figures should look like. They know what on a income and expense form or income and expense statement, they know typically what percentage is allocated to salary, what percentage for supplies, what percentage for all of the operating expenses. And then allocation of the purchase price. When you enter into a contract to purchase practice, you've got a section where you allocate the money that's being spent on the practice into a variety of categories: goodwill, covenant not to compete, equipment, supplies. And depending upon how it's allocated, you as a buyer will be depreciating those numbers, those categories. And for a buyer, you want as much into equipment and supplies as possible, because you get to deduct that as a expense in a shorter period of time as compared to goodwill or a covenant not to compete. So you need an accountant who knows how to do those kinds of things. For instance, there's an allocation line on some of the contracts floating around out there that says leasehold improvements. Well, you don't want to have something for leasehold improvements. You just eliminate it. And these categories do not relate to reality. So it's not like you need an appraisal to find out what the equipment is worth. It's typically just a balance between the those items that can be a capital gain for the seller, which is goodwill, versus those items that can be depreciable at an earlier period of time or shorter period of time for the buyer. And there's a balance between what those allocations look like. Typically, it's the accountants who get together or the attorneys who get together and create that. There's accountants out there in Northern California who just primarily do dentists. Same thing with attorneys. There's a handful of us around here who know what we're doing with dental contracts, whether it's a Western Practice Sales or Ray Irving or a Shine deal. We're familiar with the contracts, and we get in there to change things for your benefit, such as a retreatment provision, such as changing the accounts receivable provision to make sure that if you do some new work on a patient who owes money to the seller, you're going to get paid for it. You don't have to turn that money over to the seller. And you're not having to pay someone to reinvent the wheel. For instance, let's say you're buying a practice that has multiple locations in Northern California, and typically there's a covenant not to compete of 10, 15, 20 miles. Let's say there's another practice location within 5 or 10 miles. Well, typically there's a lot of patients who are seen in the practice that you're purchasing who have been seen in some of the other practices. So they're in the patient data or patient base for these other practices. And unless you have an attorney who knows that that could be a problem, when you buy a practice and you don't realize that 100, 200, 300 patients are actually considered patients of record of an adjoining practice, and your covenant not to compete carves out the ability for the seller to continue treating the patients that are part of their patient base in this neighboring practice 5 or 10 miles away, you can end up buying a heck of a smaller patient base than you thought you were going to because of this. So one of the things that we do is we nail down the patient base that you're purchasing. We have a printout of the names and addresses of all the patients that are patients of record of this practice, whether it's Dentrix or SoftDent or whatever. We print it out. We attach it to the contract of sale as an exhibit, so that you know that everybody on this list comes with the practice. And we also put in provision that states if any of the people on this list are part of the patient base of any of the other practices of the seller, any of the other locations, they've got to delete it. Because if they have some of these automatic software programs that solicit patients and invite them in for the big barbecue or whatever it is for this other dentist, you want them out of that system, because you want to be able to generate income off of these patients, and they've represented to you that there's a certain level of production you can achieve off of these patients, knowing that they're coming to this location and not migrating to another office. So having an attorney who knows what they're doing is a big deal. Consultants, I'm not wild about consultants. To me, consultants are people who don't have an initial after their name, like, an accountant does, CPA, or an attorney, ESQ. So you really can't sue them for malpractice, because what consultant malpractice? I don't think so. So you always have to be careful with consultants in your practice as far as helping you purchase. Some of them will help you do due diligence. There's a couple out there that are pretty good to figure out whether the practice is worth buying or not. But just be real careful. There's a couple, I won't mention any names since it's being recorded, and so far I haven't sued by anybody that I've talked about through the years. But there are a few bad actors out there who, number one, require a lot of money up front before they start providing you with services. Number two, they kind of promise you the world, they don't deliver. And number three, if you look at the fine print in their contracts, quite often the contract is being interpreted by law other than California. We've got one today that was an insurance contract with dental insurance company. You have to go to Kansas City, Missouri, if you want to sue the person who you're on the contract with. And it's Missouri law that applies to the contract. Yeah, it's in the fine print. So be careful with these folks. Insurance brokers, you got a handful out there who know what they're doing. You got TDIC, you got Steve Hardesty, you got Mitchell and Mitchell, you have Dentist Advantage, you have Travelor and Hessel, and then any other insurance companies that advertise at the San Mateo Dental Society, them too. But I think that kind of covers it for the majority of them. And once again, they know what they're doing, what banks require if you're going to be getting a bank loan. And then peers, having some senior members, less youthful dentists who've been veterans, been around for a while, asking them questions about, helping you review the records or helping you through the transaction, tapping on their wisdom to go through the process. Okay, conserve your capital. Do not enter into agreements blindly. You just got to be real careful what you sign, because some associate agreements have some pretty onerous terms in them. We're going to be talking about, some of that kind of stuff in a second. And there's no 24-hour get out of a contract free for agreements to enter into. So if you sign up to buy that new cone beam scanner, and it turns out that you hear some bad things the next day about the company or the vendor you purchased it from, once you sign, you're committed. So be careful with what you sign. Read every document, every word of every document that's presented to you for signature. Look to see where you have to go to sue these folks. Look to see what laws applied. One of the nice things about California is we have some good laws, batches of laws that allow us to use a variety of ways to go after bad actors for unlawful business practices, to stay away from the contract if we need to. But if somebody's working in California, somebody's selling something in California, the contract should be subject to California law and enforceable in California. Okay, covenants not to compete. We know we've heard those before. So let me tell you when they're enforceable. They are enforceable when you purchase a dental practice. So you purchase a dental practice, the seller is going to retire, the seller is going to stop practicing dentistry, or is going to continue practicing dentistry, but just not within the same area. Covenant not to compete says that for a period of time, usually 5 years, within a certain radius, 10, 15, 20 miles, that dentist will not practice dentistry. End of story. And that is enforceable if you're buying the dental practice. If you are an associate and you have a covenant not to compete that says from 5 years from when you stop working in this practice, you cannot compete anywhere in San Mateo County, that is unenforceable. So under California law, the only time a covenant not to compete is enforceable is if you're buying goodwill. when you buy a dental practice, you're buying the goodwill of the patients that come with that practice. The income stream is from treating those patients in the practice. And when practice sales are handled in an appropriate fashion, there's typically a very high retention rate, 90% or more. Typically, you're able to produce 90 to 100% of what the seller produced the year before when things go smoothly in a practice sale. If, for instance, you have a covenant not to compete that's 10 miles and the seller opens up a practice or is associating in a practice 8 miles away, then your legal remedy is to actually get a court order stopping him or her from practicing dentistry. And you can. You got to give them a warning. You have to be able to prove it, but you can go in if you can show that this person who signed an agreement said they're not going to be practicing within 8 miles, within 10 miles, is practicing within 8. Court's going to issue an injunction saying stop practicing there. And if they continue to practice, then the marshal or the sheriff will go pick them up and hold them in contempt of court. And that's a pretty effective way of keeping them from practicing within the covenant period. So covenants not to compete are enforceable in contracts of sale. They're also enforceable in a partnership agreement. So let's say a partnership owns the dental practice. You are a partner. As a partner, you own a share of the goodwill in the practice. And if you leave that practice, your partnership interest is sold back to other partners or to the partnership itself. You'll typically have a covenant not to compete that's enforceable. The same thing applies to a professional corporation. Professional corporations have shareholders, not partners. If you're a shareholder, then you own a percentage of that corporation. The corporation owns the dental practice and the goodwill. If it's structured that way, typically it is. And if you leave, you sell your shares back to the corporation, then a covenant not to compete is going to be binding on you. So partnerships, professional corporations, practice sales, covenants not to compete are enforceable. Associate agreements, they are not enforceable. There are some alternatives to covenants not to compete in associate agreements. We'll be talking about those in a little bit that you do need to be worried about. Don't be afraid to negotiate terms. You know, whether it's a lease that you're entering into or an associate agreement, you know, you should be keeping track of your production numbers, your collection numbers, patient satisfaction rates. If you're a specialist, you got happy referral sources, letting your boss know that they're happy with the treatment you're providing to the patients who are being referred to the practice. It's kind of like a professional baseball player. If you got a good batting average, if you're making some pretty good money for that practice, don't be afraid to go in and say, you know, you've been paying me, you know, a per diem of X amount per day. I've been looking at my numbers here and I'm producing, you know, 3 times that amount. How about if you give me a base of what I'm producing right now and then give me 30% of what I produce over X amount of dollars, or increase my base pay. So if you back it up with numbers and with patient satisfaction, a lot of times you can start, you know, being rewarded monetarily for your hard work, because you guys do work very hard in the dental practice and put up with an awful lot to earn your living. Take due diligence seriously. So anytime you're going to be going into a dental practice as an associate, or if you're buying a dental practice, you know, make sure you know what you're getting yourself into. Take a look into the practice owner. What's online about that person? What did the Yelp comments state? If you're thinking about buying a dental practice, well, the identity of the seller is supposed to be kept confidential, and you sign a form that says that. You still call up the executive director of the dental society where that practice is, since they pretty much know everything about everybody, and say, hey, who are the top 10 dentists in this community, and who are the bottom 10 dentists in this community? Because I'm thinking about buying a practice. I can't tell you the name, but I just want to know if that name's on, you know, one of those 2 lists. Because if it's on the bottom 10, you may not want to be purchasing that practice. And the same thing for associateships. If a practice is burning through a lot of associates, then you want to find out why. And there are some practice situations out there that are, they treat you like hamsters on one of those little wheels, and you deserve better than that. So watch out. Do not let a practice situation compromise your standard of care. There have been situations where patients are treatment planned by one dentist, and then you come in and another dentist comes in and is supposed to perform the treatment, like extractions for ortho treatment, serial extractions, etc. And the person who follows the treatment plan doesn't necessarily verify the treatment's necessary. They perform the treatment, and then there's an allegation that the treatment wasn't necessary, or the wrong tooth was extracted. And it is not an excuse for a dentist to say, well, my job is to extract teeth that are called for treatment plan by other practitioners. It's the other practitioner's fault who said extract this tooth, and it was set up on my schedule. That's not an excuse. That's not a defense. So you have to verify that what you are doing is appropriate in every situation. And whether it's a large clinic setting with a lot of patients coming and going, and you're not given a whole lot of time to treat, or it's a smaller practice, but yet you're still performing treatment that's been diagnosed by others or treatment planned by others, make sure you've got a good feeling that you've taken a look at those x-rays. You know what the foundation is, what the diagnosis is, and the findings that support it, so that you're comfortable in performing that dentistry. And I've defended a lot of docs through the years, a lot of younger doctors who've been caught in that problem where they weren't scheduled a sufficient amount of time. They were scheduled for things that were more complicated than they were comfortable handling, or they were following through with a treatment plan that somebody else put together and didn't verify it, didn't say, yes, I was sure this was a correct treatment, and that's the way mistakes happen. Okay, so 9, be careful of what you sign. Kind of already talked about that. 10, do not assume. It's kind of like, do not assume that the other guy's honest. I hate to say that, but you just got to be real careful, because anytime you go into a practice situation where you are the younger person, go into an associateship. Your associateship says in the termination provision that you have to give 90 days before you can terminate the agreement. And if you don't, you have to pay the practice owner $10,000 as liquidated damages. And you say, you know what, I just signed it. I didn't read that part. Well, you're at an economic disadvantage with a practice owner. Typically, a practice owner has been doing whatever he or she's been doing for a long time. They got some money in the bank, and you've been out there a couple of years after dental school. You got loans up the wazoo, and you don't have money to burn on an attorney to help defend you to get out of that contract, to show that it's an illegal contract. And you just assumed it was okay when you signed it because you didn't read the whole thing. Or you assume that the person who introduced you to the practice and told you that, the practice owner was a good person, you assume they were a good person. So be careful about those kinds of situations. Do not believe oral assurances. Once again, that comes back to get it in writing. Don't be taken advantage of, because that's what we see, is the younger dentists getting taken advantage. And then good luck follows hard work and smart work. And, there was a book that I read when I was growing up that my dad introduced to me called it was written by Horatio Alger. And there's stories about young kids who kind of started with nothing, but they worked hard in life and they become very successful. Well, it's the same kind of thing with any of our professions. There's the mediocre practitioners, and then there are those who are dedicated to profession, dedicated to doing things right, working hard, and typically they're the ones who are successful in the practice and really enjoy what they're doing. So hopefully you fall into that category. Okay, let's talk a little bit about associate and independent contractor checklists. I would assume that some of you are associates in practices right now. I think Ness, you had indicated that you're an associate in a practice right now. So I'm going to go over kind of a checklist of some of the top things that go into an associate agreement. So number one is you want to make sure everything's in writing. So a handshake doesn't cut it. And at the very least, you would have this outline of terms that we're going to be talking about tonight. So you could sit down, knock out a Word document that just contains a confirmation of the terms that you've agreed to, have both parties sign it and date it. That's it. You've got an agreement. Don't have to spend money to have an attorney do it. Not that you shouldn't, but getting something in writing, even if it's by a layperson, becomes an enforceable document. So that's great. Relationship with the parties, employee or independent contractor. And there's been a lot of discussion, a lot of recommendations out there. I'll share with you my recommendation and my experience. So I like associates when they are independent contractors. The independent contractor relationship, in my mind, is a win-win situation because you have practice owners who don't have to pay payroll taxes. So that's 7, 8, 9% savings on what they're paying the associate. And they don't have to pay workers' compensation insurance based on a payroll that includes dentists, the employee dentists, because they're independent contractors. And furthermore, depending upon who your accountant is, some accountants require that if you're going to be using them for accounting services, you have to have maintain a pension account with them as well. And in those situations, a lot of times they recommend strongly that you have all your associates be employees. And one of the reasons for that is if they're an employee, then you have to contribute to a pension plan for them. And since the accountants operate a pension plan company that you've got to use, and they charge you 1% per year to manage all that money, it's in their interest for you to hire employees as dentists rather than independent contractors. So it's for the benefit of the practice. And then what about you? Well, I see it as an advantage for you as well. It's an advantage for you because you are able to expense business expenses like your computer, like travel, like promotion, taking folks out to eat and promoting yourself as a dentist. Pretty much everything you do that is business oriented, you can deduct as an independent contractor where you can't do that as an employee. And when practice owners ask accountants, there were some changes in the law a few years ago that put a greater emphasis on the employment development department calling dentists employees. So everybody said, oh, they all got to be employees. One of the ways that we found that it's been pretty much bulletproof is for the independent contractor, for the associate to incorporate. So you have a professional corporation. It's your professional corporation that enters into the associate agreement. And knock on wood, I have not seen a single associate who's a professional corporation who is then hired by a practice. I have not seen the EDD or IRS challenge that relationship. It's just too difficult because a corporation is considered a individual under the law. It's got its own tax ID number. And then your corporation will either pay you a salary or distribute the salary, the income to you. And as a corporation, once again, it lends itself very nicely into you then buying a practice and having your corporation all ready to go to buy a practice. or you can put together a pension plan as a corporation that is fatter and sweeter than you could if you were an employee. So I like independent contractor status as between an employee or independent contractor for liability purposes. It's basically the same. You are liable for any patient who you touch, whether you're an employee or independent contractor. As a practice owner, because you own the facility, you are vicariously liable. You stand in the second position to the person who's actually doing the treatment to be liable to the patient. So no matter whether you're an employee or independent contractor, the dentist doing the treatment is liable for any claims of malpractice, and the practice owner is secondarily liable as well. Okay, terms of the agreement, you know, what I see is quite often a per diem, whether it's $750, $1,000, $1,500 for specialists or more. That's how much you're paid on a per day basis, no matter how many patients you see or treat. There are some practices that go with a percentage of collections or production. Collections is a larger number than production if you're paid on collections, because you don't get paid until the dentist gets paid. So if your collections are typically running 80 or 90%, you know, you get the money within 60 days, then if you agree to, you know, 40% of collections, and you know you're going to get fully paid for the work you've done 2 months ago, you know, in 2 months' time. If you're being paid on a production basis, it's typically a smaller amount because the practice owner is fronting the money for you. You know, 30% of production every 2 weeks, and then the collectability is on the practice owner. And you see a hybrid of the two of those, you know, a base of X amount of dollars, and if you produce over a certain number, then you're going to get a percentage of that number. I do see two items on the chat. If anybody has any questions, Ness, you said you were going to pop in with your photo, your video, and then ask questions. So if that's what the chat is for, just to remind you, I'm open for questions before we lose this stuff in the weeds. Are there a couple of questions?
Right, as far as I see right now, no.
Okay.
Oh, actually, wait. Yes, I believe we have a question out there asking, what are average percentages for production / collection? There we go. I just got it. Yeah.
Good question. And it's kind of tough, but it's typically between 30 and 35% of production and 35 to 40% of collections. So that's generally the sweet for non-specialists.
All right.
Nailed that one? Got that one?
I believe so.
Okay, good deal. So once again, just pop in anytime there are any questions.
Will do.
Okay, so taxes, you know, if one thing I didn't touch on is, if you are an employee, the employer pays 6.5% of your Medicare Social Security taxes. If you're an independent contractor, you or your professional corporation are going to have to pay the full 13% of the Medicare wages, a tax on your wages. So you do pay an additional 6.5% in taxes, in essence, as an independent contractor as compared to an employee. But once again, that's balanced against, or that's put in contrast to what you're able to deduct as your own practice owner, as independent contractor through your corporation, which is pretty much everything that you can imagine that may relate to dentistry. So, so an employee, they do withholding, get a paycheck with the net amount owed to you after taxes are withheld. If you're an independent contractor, there's no withholding, and it's up to you to make sure you make quarterly estimated tax benefits to the IRS and the state so that at the end of the year, there's, a bunch of money you've paid to offset what your tax liability is going to be. And that's why, once again, having an accountant who knows dentistry is helpful, because they're going to know what tax bracket you're going to be falling into. They're going to know how to set that up for you so that every quarter you make your quarterly payments and you don't run into tax problems at the end of the year. Okay, typically with an associate agreement, the only expense that may be passed on to you would be the lab fee or half the lab fee. Otherwise, there really isn't anything else that's passed on to you as an expense. For practitioners who place implants in a practice that doesn't place implants, if you come in as an associate, either a GP or a specialist, and you place implants, there are times when the agreement says you bring in the implant parts, and the practice owner will reimburse you for those implant parts, potentially pay you on a per implant basis as well. So that's one of the areas that we see some specialization for those practitioners who bring that into the practice. Ownership interest in a practice that's owned by somebody else, they consider themselves the owners of the practice. And you have to keep that in mind, that in dental practices, what a practice owner owns is the opportunity to treat those patients, the goodwill. Nobody owns patients, and patients have a choice to be treated with by whomever they want. But patients are creatures of habit. They like the front desk person. They like the hygienist. They like the dentist. Sometimes the dentist is number 3 on that list, but still, they like the dentist. And if that practice is sold and they still see the same front desk person, they still see the same hygienist, they'll come back. They're going to give you a shot. And if they like what they see, they're going to keep coming back. So that's what a practice owner owns. And an associate who comes into the practice, who takes that goodwill away, who solicits it away. My tongue's not falling in the right spot there. Who takes some action to interfere with that relationship is typically going to get into trouble. Unless you got a question there.
Yes, we got a question right here. You mentioned that as an independent contractor, you are liable for patient care. How is the owner doctor liable as a second party in that scenario?
Okay, good question. So the practice owner is responsible because they, in essence, are the proprietors who own the facility. And patients are coming to that facility, kind of what I'm touching on right now. And the owner, who's profiting off of the associate's work, stands in the same shoes as the associate from a liability perspective. So it's kind of similar to, a franchise. If a franchise is owned by somebody and they're operating it, and you go to that franchise and you have a slip and fall and injure yourself, then the franchise owner is responsible, and so is the franchisee, because it's the name that you're going to. So under the law, the practice owner is vicariously liable, also liable for the actions of an associate. And the same thing works with respect to partners. Partners are legally responsible for bad things that their partners do. So if you're in a dental partnership and your partner commits malpractice, then both partners are named in a lawsuit, even though only one partner did the treatment. Or if there's a sexual harassment claim against one of the partners, the other partner had nothing to do with the partnership, both partners are equally liable. And that's one thing that a professional corporation can give you is, especially if you own your practice, some limited liability. So you, the professional, are not personally responsible. Doesn't apply to malpractice. If you're a professional corporation and you're alleged of malpractice, then you as an individual are liable under the law. but it does apply to employment-based cases. So if you're a professional corporation, your corporation employs your employees, an employee wants to sue for sexual harassment and wrongful termination, they can only go after the corporation and typically not go after you as an individual. So it gives you some protection there.
Interesting. Okay. We have another question here, Mr. Goldman. So in regards to a non-solicitation agreement, if you inform patients you are leaving the practice, but not necessarily revealing where you are going to, is that a violation of the non-solicitation agreement as well?
So with solicitation, let me start with a couple of things. So number one is you're dealing with an attitude, typically with a practice owner, that that all of the patients are coming there because of that practice owner, not because of you. So if you leave, they will get upset if they hear the patients are leaving to follow you. And if they find any evidence that you've actually contacted patients to follow you, then they may take legal action against you. So the first thing you're going to look at is, do you have a written employment agreement that specifies that there's non-solicitation? And if it does specify that, then see what it says. It may say that you cannot tell patients where you're going to be going. It may say that if you have a LinkedIn page, you can't identify that you've left a practice, you're now practicing somewhere else. Or if you have a Facebook page, you can't say, I'm so happy to be out of Dr. Smith's office and so happy to be in Dr. Jones' office. So you need to see what that contract says. Or if you, or you have an employment agreement, look there, and then take a look at the employment policies of the office if you're an employee, because then they apply to you. Generally, you have a right to let patients know where you're going. Generally, you have a right to advertise by way of neutral advertising like AdPack, or a website or LinkedIn or Facebook where you're practicing. They can't stop you from doing that. But anytime you are directly communicating to a patient that you're no longer practicing there and you'd love to see them somewhere else, you just have to be careful as to what the non-solicitation provision says. If you're in a practice where there isn't anything, Ness, do you have a written employment agreement for where you're practicing right now?
Can I answer that later?
Okay. Let me ask you this generally. Do you know if you have a non-solicitation provision in anything you've signed in that practice?
I'll be honest with you, I am not sure.
Okay. And that's a good answer, because you're thinking to yourself, hey, why would I even worry about that where I am right now? And there are times when you say, you know what, I do have to worry about that. Is there something in writing? Or if you're coming into a relationship, non-solicitation provision is what you want to look at to see how restrictive it might be. One thing that, let me get to the next slide and I'll talk about it here. So,
I guess there's I didn't want to interrupt, Mr. Goldman. I guess we have another question, like on the board too, actually.
But say that once again?
Oh, we had another, actually another question came up, but I wanted to let you
finish? Okay.
Yeah.
So covenants not to compete are not enforceable in associate agreements. Anti-solicitation provisions are, and there's also something called the liquidated damages provision. And that's can be more potent than a non-solicitation provision. Liquidated damages provision says as follows. Number one, all of the patients in this practice belong to the practice owner. It says they are all patients of record of the practice owner. And if you as an associate go out and compete, which you're allowed to do, if any of these patients of record transferred to you to be treated by you or in the practice that you're in within, say, 2 years of when you leave this practice, then you have to pay the practice, in essence, for that little bit of goodwill that was lost, $1,500, $2,000, something like that. And that provision is enforceable. So you have to be careful and look at those provisions. Sometimes what you can do is you can negotiate so that a liquidated damages provision or even a non-solicitation doesn't kick into effect until you've left the practice. You know, you've got to be there. Sorry, you got to be there for a year before the liquidated damages kicks in. So if you're only there 6 months and you're out of there, you haven't met enough patients to be a threat. Or you reduce the amount of money on the liquidated damages, or you put in a friends and family exception. You say, hey, on a monthly basis, you're going to sit down with the practice owner, take a look at the new patients coming to the practice. And if you are the reason those new patients came into the practice, then you keep track of them. And if it comes time for you to leave the practice, those folks are excluded from a non-solicitation liquidated damages provision. So that's really an area where you may not pay much attention when you're getting into the relationship, but you really need to focus on it because that's where we see the greatest amount of litigation or disputes between practice owners and associates when associates want to leave an associate somewhere else or buy a practice, whether it's next door or within the same neighborhood, they have to worry about those provisions. So what's the next question?
Let's see. Is the associate liable if there is a legal issue that comes up because of the management? For example, if the patient files a lawsuit or board complaint because of a billing issue created by the front desk mistake, then that's what the question reads.
Sure. So you could potentially be dragged into certain things. You know, the dental board goes out of its way to create problems for dentists, but typically if there's a board complaint, you're going to receive a notice from the dental board that says, okay, Joe Smith, a patient has complained about you. What is your side of the story? Please explain. And that gives you an opportunity to say, I was associate in the practice. I understand there's a billing dispute. I had nothing to do with the billing. Billing management decisions were made by the practice manager or by the practice owner. So that should get you off the hook. But you can still, I've got one right now that we're defending where a patient, the associate was the orthodontist in the practice. It came time to deband, and they have a debanding form that the office has created. They pulled out the early termination of ortho treatment instead. The support staff gave that to the patient. The patient got upset by saying, well, I thought I'm done, and now you're telling me I'm not done. Left the practice in a huff, didn't come back, went to another practitioner who actually took the treatment in a slightly different direction, not because treatment wasn't completed, but because of some aesthetics. And the patient ended up suing the orthodontist, claiming abandonment and claiming that they were lied to because the dentist said they were finished and the practice said, no, they're not, because of the form that was given to them. It's in a small claims suit, but that is one of those situations where the staff screwed up and involved the associate. So it can happen, but it is rare. And secondly, if you're in a practice where, that kind of stuff is kind of sloppy, then you got to be real careful and potentially get out of there to avoid getting pulled into something.
Right.
Okay, no more pending questions?
No, not at the moment.
Okay, good deal. I'll move on. So a couple of things. Just take a look at my time here, make sure we got plenty of time. If you're an associate in a practice, no matter independent contractor or employee, make sure that that office has malpractice insurance. You do not want to be in a practice that does not have malpractice insurance. If you're an independent contractor or professional corporation that's contracting with the practice, make sure they have workers' comp insurance on all the staff members. Make sure that they have what's called an office package, so that if somebody slips and falls on the tearing the carpet and they whack their jaw and break it, it's not because of dental malpractice, it's because they had a rip in the carpet. That's covered by general liability insurance, the office package. That becomes more important if you're an independent contractor, because they can argue that you had a duty to keep a safe premises. So those are the key insurances that you want to make sure are in place. As a practice owner, there's something called Employment Practices Liability Insurance, EPLI, and that covers when an employee sues you or has a claim for sexual harassment, for wrongful termination, and that's great insurance to have if you're a practice owner. It works a little differently than malpractice insurance, and it does not cover wage and hour claims. We're going to touch on that a little bit later. If you're in a practice, termination, death, disability, sale, option to purchase, typically associate agreements can be terminated in 30 days. Okay, if it's longer than that and there's a liquidated damages and say, hey, we're going to come after you if you terminate sooner than 90 days, you're going to owe us a bunch of money. Be careful of those. Either cross them out, don't go for it, or know that you might get some heavy-handedness if you want to get out of there in less than 30 days or 60 days, and they haven't found a replacement. But talk to the people, see if you can work that out. Sometimes you're working in a practice where the practice owner says, hey kid, something happens to me, you can buy the practice. You want to get that in writing. And we've got a provision that we use that we would put into the associate agreement that basically says, in the event of the death or disability of the practice owner, the associate has a first right to purchase, and that works that within 60 days after the disability, the triggering event or death, an appraiser comes in to appraise the practice, and if it's accepted by the associate, then the associate puts 20% down, and there's a promissory note paid over 5 years for the balance. You get that in writing, you're going to have a right to buy that practice. You can also say a right of first refusal. If anybody comes along to make an offer on the practice, you as an associate are in first position to match that offer to buy the practice. So those are good things to have if you can, if you run into a practice situation with those. Okay, so we've covered those anti-solicitation, liquidated damages. Just be careful of those. Let's move on to partnership and shareholder agreements. Okay, so I could talk for a couple of hours just on partnership agreements. Anytime that you have two or more dentists, working together, whether they are related or not, it's a difficult thing because there's a lot of ego involved at times in the practice of dentistry. There's kind of some artistry that goes along, and artists tend to be sometimes egocentric. So it's not always an easy thing to get along with other dentists. And some of the nastiest business divorces, I like to call it, that we've handled have been between partners. And some of the nastiest ones have been between family members who are dentists in jointly owned dental practices or in dental practices. So a partnership agreement is an agreement that basically sets forth your rights, your liabilities, who owns what, between the parties who have an interest in a practice, and is kind of your prenuptial in the event that there's a death, a disability, somebody wants out, somebody loses their dental license, there's a default. So it covers all of these things. It goes from the day-to-day operation of the practice to what happens in the event that one of these contingencies occurs. And it needs to all be laid out so that you're a couple of young professionals, you're practicing together, you own things 50-50, things are going great. And one of you gets involved in a skiing accident and poof, next day you're gone. You want to have a provision in that partnership agreement that says we both purchased $500,000 worth of life insurance on each other, and that will be the amount that's paid through the life insurance to transfer the interest of the deceased partner to the surviving partner. Boom, done, end of story. so that you're not getting involved with the family, you're not getting involved with appraising the practice. You know, what do you do with the accounts receivable? It's all laid out in the partnership agreement. Somebody becomes disabled, somebody wants to take pregnancy leave or parental leave. All of those kinds of things need to be nailed down in that agreement. And once again, not to tout my own horn or those of the other attorneys who do dental business law, you want to go with somebody who knows what they're doing with these partnership agreements, so that it's customized to the practice of dentistry. For instance, in a partnership agreement for dentists, we always cover what do we do with the patients in the event of a dissolution. Are all of the patients do all of the patients in the practice, are they all patients of record of the partnership, or are we going to assign each partner who treats those patients the doctor of record designation, so that if there's a split up, the partnership agreement states if the two doctors want to go their own separate ways, they can then take those patients who are their patients of record. So if one doctor has 60% of the patient base, the other has 40, it's a 50-50 partnership. It's not being split 50-50 and you're fighting over patients, or one of your patients are going to 10% are going to want to go back to one guy or the other. It's set out so that, you know, the Dentrix is Dr. 1 and Dr. 2, and Dr. 1 gets to notify all of the Dr. 1 patients that this is where we're going now, and the same thing for Dr. number 2. So all of those things need to be laid out very specifically in a partnership. And in the practice of dentistry, the legal entities you can have, business entities. Number one, a sole proprietorship. So if you're practicing by yourself, it's a sole proprietorship. A partnership, so it's two or more dentists practicing together in a jointly owned practice, or a professional corporation. Professional corporation can own a dental practice, and you're not partners. You don't use the term partners for a professional corporation. You own shares in the professional corporation. And instead of having a partnership agreement, you have a shareholder agreement. And the shareholder agreement has all the same stuff as a partnership agreement. It says, okay, this is how we're going to handle the expenses and the net profits on a day-to-day basis. This is what happens in the event of death, disability, termination. So with the partnership agreement, it's called a partnership agreement. With a corporation, it's called a shareholder agreement. And it's not, you know, you form a professional corporation, you got something called bylaws. Bylaws are just basic form, whether you're General Motors or a dental practice, they all kind of say the same thing. That's not going to help you in the event of a death or a disability. That's where you get into, you know, the shareholder agreement specifying what's what. If you are a younger practitioner and you're buying into a practice from a seasoned professional, then in the partnership agreement or shareholder agreement, you go over things like there are certain purchases that have to be with the unanimous consent. So let's say you're a 49% owner or 25% owner of stock. If the practice owner or the majority owner wants to buy a $50,000 CBCT, and you know you're kind of scraping by and saying, you know, I'd really like to use 25% of that to pay down my school loans. If you have a provision in the management part of the partnership agreement that says that any expense for equipment over $5,000 has to be unanimous consent, then you've got protection. Because if you say no, that thing doesn't get purchased, there's more money for distribution to you. So a lot of that goes into the formation of a partnership agreement or shareholder agreement. And it's not the kind of thing that you want to go online and find one that somebody else did, have it passed down, or have, you know, your uncle who's an attorney who pulls one of these things out of a form book, puts together for you. So one other comment about partnerships and shareholders. and professional corporations is that so for liability, partners are liable for whatever the other partner does. In a professional corporation, the shareholders are not liable for what the corporation does. If you enter into a lease as a partnership, there are no personal guarantees, just the partnership is the tenant. And, you know, COVID-19 hits and you go out of business, then as a, did I say corporation? Yeah, as a corporation, the landlord cannot come after you as a shareholder for that breach lease. If it was a partnership, then both of the partners are individually liable for the breach of lease. What we do for partnerships quite often is we take each partner who's a dentist and they form professional corporations. And those professional corporations are the partners in the partnership. So now you've got professional corporation A and B forming the partnership and entering into contracts or hiring individuals, so that if there's a lawsuit that could involve going after the partners, the individuals have protection because they're incorporated, so that only the corporations can get tagged. And it's especially useful in employment litigation. And just to touch on it for a second, we've had a couple of cases where good meaning dentists end up in significant cases with a significant exposure. Typically, when they do an alternative work week for their employees, they don't do it correctly. They end up owing their employees for overtime for you know, every day they're open for the last 3 years, plus waiting time penalties, literally hundreds of thousands of dollars in wage and hour claims. In those situations, when we've had professional corporations, we've actually been able to bankrupt the professional corporation, take it through bankruptcy. The individual dentist maintains his or her ownership interest of the goodwill. They can remain in their office because typically they personally guaranteed the lease, so that they remain on the lease, because the business, the employer of these employees who are suing the professional corporation, have judgments against them. Typically, they're not hired again for that practice. And the individual either reopens the practice in the same location, buys his or her depreciated equipment back from the trustee, treats the same patient base because the bankruptcy court really can't handle that, and is able to discharge hundreds of thousands of dollars in employment claims or employment judgments because they're a professional corporation. So we've done that twice in the 40 years that I've practiced, and it's worked out pretty well. So, so there's some good reasons to incorporate either when you're buying your own practice, when you get large enough of your sole proprietor, you go into a partnership, then that's a good time for both partners to become professional corporations as well. Okay, let's talk about purchasing a dental practice. And once again, as I had talked about previously, typically you're going to have a practice broker that's involved in a practice sale. And, you know, just sort of as much as I am fond of a couple of practice brokers out there, most of them just picture like a pirate patch over their eye and a parrot on their shoulder, because their job is to get a practice sold. And a lot of them are going to tell you, hey kid, this is a chance of a lifetime. We got 10 other people bidding on this, but we're going to cut you a break and let you have this practice. So don't believe anything the practice broker says. That's number one. You got a short period of time to do your due diligence, to get your ducks in a row, get your professional team together to make sure this practice is a good fit for you. Typically, you're going to want to get 3 years worth of financial records, tax returns, production and collection reports, income and expense, or profit and loss statements, and you typically hand those over to your CPA, typically a dental accountant, and they're going to go through them, and they're going to make some adjustments. Maybe the practice owner has their kids on payroll, so they're going to back that out to say, well, that's going to be more income for you. They got their Mercedes-Benz lease payment running through the business. They're going to back that out. That's going to be more funds available to you. So they make sure the numbers work out to cover the overhead, cover your school loan, cover your loan to buy the practice. And you need to know that, because if the practice is overpriced and it doesn't wash out, you're not going to have enough money on a monthly basis. And the accountants assume a 10% decrease in production, 20% decrease in production, which is typical for your first year. If there aren't sufficient funds there, and they say, you know what, either I'm paying too much and I'm going to offer less now that I've done my financial due diligence, or I'm just going to walk away. I'm backing out of this deal because financially it just doesn't look as good as it should. And that's something that is, you want to make sure you get your hands on that stuff and get it turned over to an accountant who knows what they're doing. What you do have control over is the quality of care, the chart audit. And that's a situation where you want to get your hands on the physical charts. If they got physical charts, these days, they're more in the way of electronic charts. So whether it's running reports through Dentrix or SoftDent or whatever dental program system they use, you should have free access to get in there, run reports. How many patients have been treated, in the last year? What is the breakdown of restorative, hygiene, x-rays? What do those numbers look like? And what do they look like over the last 2 to 3 years? Has there been any, how many patients are coming into the practice? How many new patients are coming into the practice? Looking to see if we had a case where a buyer bought a practice by a fella who was committing fraud on patients by basically doing everything that could be done to a healthy tooth over, a fairly short period of time, from performing pulpotomies that weren't necessary, turning them into root canals, turning them into INDs, crown buildups and posts on multiple teeth. This guy, I think, has been convicted for insurance fraud and battery. And it was primarily through the work that we did after we got hired to help the buyer out, because the buyer said, wait a minute, now everything's been done in all these patients' mouths. And now that I've really taken the time to look into it, the x-rays don't justify this stuff. These are all healthy teeth. What's going on here? Well, that's what should have been determined during the chart audit. And whenever you run into roadblocks, typically you get to perform your chart audit after you've signed either a contract of sale or you've signed the letter of intent to buy the practice. And you should be able to go in there and sniff around on a Saturday or a Sunday as much as you want. You typically want to take a look at randomly charts from every letter of the alphabet and see what they look like, see what the financial plans look like. Take a look at the ledgers, make sure the ledgers look clean. A lot of the fraud is hard to parse out, and then a lot of it is much easier by taking a good look at what's going on in the practice. If it's a practice that a lot of times places implants, there are secret implant warranties where patients are told, if the implant ever fails, I'll replace it for free. If it fails within 1 year, I'll replace it for free. So you got to find out about that. Handling one right now where you go to the website of the practitioner, it's implant this and the international fellowship of that, shaking hands with the president, holding an implant, all kinds of stuff. Well, it's a general practitioner, and I asked the buyer to ask the seller, what do you give in the way of a guarantee for implants? And sure enough, it's not in writing, but every patient's told if this implant ever fails, I replace it for free. So that's then something that we put into the contract of sale that says, in the event an implant that was placed by the seller ever fails, then the seller can come back in to replace it if the seller still has a valid dental license and insurance, or we can replace it and the seller has to reimburse us for it. So that's kind of how you sniff that stuff out. If you're in a specialty practice, there's some other considerations about verifying the referrals to the practice and who's on that list and how many referrals are they sending over your way, and whether there's been an increase or decrease or a steady plateau of those referrals. So quality of care comes down to you. You got to get in there, roll up your sleeves, and take a good look at everything. Insurance risk management considerations. You want to make sure that seller has malpractice insurance. It's been a long time since I've run into a practice sale where the seller doesn't have malpractice insurance. If they don't, it becomes a liability for you, a potential liability for you to treat a patient where there's some potential malpractice by the seller. You've got insurance, seller doesn't have insurance, they're going to come after you for something that's going on. So you want to stay away from a practice that does not have insurance. Under item 4, managed care, let's talk about Delta Premier. As you know, Delta Premier stopped being granted to dentists in about 2014 or so. A lot of the practices that are for sale these days are for Premier practitioners. A lot of those Premier practitioners have a high percentage of their income being generated off of Premier patients, and that's going to drop. That's, if you're going to become a Delta PPO, you're going to be seeing a drop of 30% in the reimbursement rates. If you're going to go out of network, then it could be even more. So number one is you've got to discount the factors and what that practice is worth, knowing you're going to have a decrease in the production. Number two, you're going to want to see how much of that production is being generated in the practice off of Premier patients. Is it 20%, which isn't that big a deal, or is it 70%, which is a big deal? And you want to you want to be prepared for that. There are in agreements, bridge agreements basically state for up to 90 days after you purchase the practice, you can continue billing in the seller's name, so that until you become a PPO or out of network provider. There are a lot of different thoughts on doing that kind of thing. It's typically done. My experience is carriers typically don't mind it if it's for a short period of time. We have 3 pending lawsuits against Delta Premier, including one that's a potential class action. So if you go to our website, goldmanlawfirm.net, you can read up a little bit more about the lawsuits we have against Delta and some of the tricks they've been up to. But you really got to flesh that out to know that what to expect when you get into that practice, because sooner or later you're going to have to either immediately or some short period of time later, you're going to have to drop Premier. You're not going to be able to obtain those same kind of fees. So you got to be prepared for that. Other considerations, associates in the practice. We've run into problems before where there've been long-term associates. They have great relationships with patients. They've been producing a lot of money in the practice. And the practice owner may even be a absentee owner. Wants to sell you the practice. You said, well, what about the associate? How come the associate's not buying? Oh, I couldn't come to terms. Where's the associate going? I don't know. So you want to pay top dollar for a practice that looks really good with an associate. It could open up next door because there's not a written contract for the associate. There's no non-solicitation. There's no liquidated damages. And you want to talk to the associate to find out where they're going. You think they're going to tell you where they're going? A lot of times they have the unfettered ability to work wherever they want to work, open up their own practice, and then let patients know where they are, or just do ad pack advertising to say, I'm happy to announce all the patients I've seen through the years that I'm practicing on my own now over here. That kind of thing is legal. So you got to be real careful if there have been associates in the practice, because that can destroy a good looking practice when you come into it. Other dentists in the practice, often there's a, Joe Blow owns the Wiggle Bug, and we got shared equipment over here, and we got, the front office has shared equipment. You need to nail that stuff down. If you're buying a practice where there's a shared environment, you got to nail down what's owned 100% by the seller, and get the person who owns a partial interest in some of this stuff to sign off and say, yeah, I agree. This is all owned by the seller. And then have that list that says, things are owned 50-50 with this other person, and have this other person sign off. I've had lawsuits over who owns the furniture, who owns the Wiggle Bug, because this kind of stuff hasn't been nailed down during the transaction before it closes. Advertising in the practice, that comes down to the website, the domain name, the emails associated with the domain name. We got all kinds of fights about that kind of stuff these days. The trade name, who owns the trade name? Are all of these things covered in the contract of sale to make sure that you as the buyer are getting them? If they're not specifically stated, remember what I said before, it's not in writing, it doesn't count, you may not own it. You probably don't own it. So nail this stuff down. The domain name, the web content, fictitious names. If there's a fictitious name being used that's not registered with the county recorder, get the doggone thing recorded in your name as soon as possible, because somebody else might own it or might try to pick it up. Seller staff, typically seller staff doesn't know anything about the practice sale. They keep them in the dark until a week or so before the practice sale. It's a good thing for you to insist on interviewing the staff before the close, because staff can be difficult. Typically, staff are not compensated with any kind of bonus from the seller. They're usually dedicated to the patient base. They're usually supportive of a new person coming into the practice. But sometimes you run into staff that's been abused. They've been told they're going to get raises. They don't get raises. They've been told they'd have a choice on who the practice is sold to, and they're not given a choice. So you want to make sure that the staff is going to be dedicated to you and helping you out when you buy the practice, and who you think you're going to keep on board. Key people are front desk person and hygienists. Not so much DAs, but once again, in today's marketplace, as most of you know, it's really tough to come up with good help these days in a dental practice. So make sure you're able to get in there and meet with the support staff. Okay, that kind of covers it for buying a dental practice. Let me know if you have any questions. Policing staff and others. We're going to kind of switch our hats now to employment law and some of the stuff that goes along with that. So employees as patients, that's a real tough one. If you're treating your employee and something goes sideways, then not only are you looking at a malpractice lawsuit, but you're also looking at a potential sexual harassment or wrongful termination lawsuit. These days with employees, you don't use these. You don't touch employees. You don't put your hands on their shoulders and move them out of the way. You don't put your hands on their hips and move them out of the way. You don't hug them. They got their personal space. You got your personal space. You need to respect it. No touching. What do you do with a patient? You touch a patient. You got to touch a patient. We had a complaint the other day by a call from a doc, practice owner, who had a very upset mother with a young patient who was being treated by an associate, where the associate was placing the dental instruments and some of the other items that were being used in the mouth on the chest of a young female. And the young female felt like she was being touched inappropriately. So you got to be very concerned about these kinds of things. And with employees as patients, You don't do it after hours when nobody else is around. You treat them no differently than a regular patient. You have a chart, looks no different than a regular chart. You go the full Monty. So if you're sued for malpractice, it looks exactly the way it should. If you're sued for, improperly touching a patient, you had your dental assistant in the room. Everything was done the way you usually do with all the other patients. So you protect yourself. Relations with employees or between employees, that's tough stuff. You gotta either have a policy where that doesn't take place, or if it does, a practice owner with employee is a big no-no. You're going to get sued sooner or later. It's not a good thing. If I was just thinking about also having a relationship with a patient. So a relationship with an employee or a relationship with a patient, if it becomes a physical relationship, then you can lose your dental license over having a relationship with a patient. So they gotta stop being a patient. And it's almost the same thing with employees. And if the employee stops being an employee, then they're going to sue you for sexual harassment. So just be real careful, and try to stay away from those kinds of things. Conduct of patients. We've had a patient whose hand kept popping up on the leg of the hygienist every time he came to see the hygienist. Hygienist said, "I'm not happy being touched by this patient." The doc's job is to talk to that patient and say, "Hey, cut it out. Can't do it. You do it again, we're going to kick you out of the practice." Or, we've got 6'10" Theodore, who's our hygienist, who's going to be treating you from now on. And if you put your hand on Theodore, he's gonna slug you. So no more of that kind of stuff. So conduct of patients, you as a practice owner need to guard it. Conduct of vendors. You got vendors coming and going all the time. And it's a similar kind of thing. You have a vendor hanging out at the front desk, hitting on the front desk person. Then it's up to you to step in and say, cut it out. If you have a patient who's potentially a threat to the practice, then once again, you are the person who has to potentially obtain a civil harassment injunction to keep them away. You may have to take steps to educate your staff so that if the staff sees this person show up at the office, they call 911 and there's a code word they use so everybody gets out of the practice. We've had that happen before with nut cases of patients. Okay, let's talk about some employment law basics. So we're racing through the business of practicing dentistry. Now we're going to talk about what you need to worry about most. Malpractice, we're not talking about malpractice. You hardly ever see malpractice, knock on wood. And you got insurance to cover malpractice. Okay, you're trained on how to do things right. And 98% of the time, 99% of the time, you're doing things right. Who trains you on employment law? Nobody. And it's tricky stuff. So let's talk about it just a little bit. Number one is, who's most likely to sue you in your dental practice? Your employees. Why? Because they can make a hell of a lot of money at it. Number two, nobody except the plaintiff's attorneys know how the rules work, and the rules work against you. Welcome to California. But please don't move away. Number three, there are incentives for employees to sue you. One of the incentive is if you haven't paid them correctly for, let's say, an hour of overtime, you didn't pay them, and then they more than 30 days goes after you owed them the 1 hour of overtime, they're entitled to a waiting time penalty of 30 times their average daily wage. So if you have a hygienist who's there 2 times a week, he or she's paid $500 a day, and they work an hour of overtime, and you don't pay them the overtime, and more than 30 days goes on, then what's 30 times 500? That's the waiting time penalty. So there's incentives for the employees to come after you. And then there's an incentive for the attorneys in the majority of wage and hour claims. And I'm going to break it down into 2 different kinds of claims. In wage and hour claims, typically the attorney for the employee is awarded attorney's fees. So it is to their incentive to work the case up, work their attorney's fees up, so that even if they only get an hour's worth of overtime and their bill's $5,000, $10,000, $15,000, they're going to get their attorney's fees awarded to them as well. So the types of lawsuits you see by employees are typically wage and hour, which is similar to what you would see pursued in a labor commissioner action, where you have failed to pay overtime, you've failed to pay for lunch breaks, meal breaks, you have an alternative work week that hasn't been voted on secretly, hasn't been registered with the Department of Industrial Relations. Those are labor commissioner actions. Okay, wrongful termination, that's where you have, I got terminated because I wore a religious object to work and it's a religion that my boss doesn't like. I quit because somebody kept staring at portions of my body, which made me uncomfortable, and I asked them to stop it and they wouldn't. And it was a pervasively sexually oriented workplace. That's why I quit. Or I was terminated because I wore a political hat that the other side didn't like. So that's wrongful termination. So the two types: wrongful termination, sexual harassment, wrongful termination. You fired me for an illegal purpose, or wage and hour, which is labor commissioner actions. Also, with malpractice cases, there's a limit on how much wage and hour. There's how much a patient can collect for pain and suffering. So whether a patient loses one tooth, one arm, all their teeth, all of their appendages, the maximum they can get for pain and suffering is $250,000. That was set back in 1974 when they passed the MICRA medical insurance. Let's see, medical. You know what? I forget what I stands for. But it places the limits on pain and suffering and attorney's fees for plaintiffs in malpractice cases. So there's a disincentive. Attorneys don't like malpractice cases against dentists. They're too small. But attorneys love employment law cases against dentists because dentists are easy marks. They don't have HR departments, and dentists are too busy to fight. So they're easy marks for settlements. So some of your best protection: number one, written employment agreements. Get every employee to sign an employment agreement that says, hey, I've been hired at will. If I'm unhappy and I want to sue you, I got to go to mediation first. And if mediation doesn't settle the case and I want to sue you, then there's no lawsuit. It's binding arbitration, so that you don't get this case in front of a jury. We've tried a couple of sexual harassment cases where it's a female against a male. You go in front of a jury, picking the jury back in the good old days before COVID-19, and you say, okay, ladies and gentlemen of the jury, you got prospective jurors. How many of you have been felt like you've been victims of sexual harassment? Every single female hand goes up. You look at the guys, and the guys are going, hey, I wish I was so lucky. I go, wait a minute now, I'm not so sure about this. It's just the way it is. You try a sexual harassment case in front of a jury, and you're going to have the majority of the females on that jury having experienced something like that before. And that's a tough thing to unbundle, to have a fair and impartial jury. So as a practice owner, you say, hey, how can I protect myself? Binding arbitration, one judge. And it's typically someone who's been there, they've heard it all. They're not going to react to these accusations like a potential jury would. So binding arbitration, part of that written employment agreement, and it's incorporated into a handbook. You don't have to have a handbook, but you need to have a written employment agreement with these items in it. And there's a company that puts out, lots of different companies put out all of this kind of stuff. And you got to have an attorney behind it. If you don't have an attorney behind it, you get some weird stuff. There's a binding arbitration agreement floating out there with one of the popular programs where it's binding arbitration according to the laws of Kansas, something like that. And it's somehow it got picked up in this manual, and it's repeated over and over again. We run into that. We have to litigate it. We can't use that binding arbitration agreement because it's not enforceable under California law. So what goes along with your employment agreement is an employment manual. And once again, it should be custom drafted to your practice. And that creates a contract between you and your employees. There's some weird employment policy manuals out there that say this is not a contract. Right below you sign it, it says this is binding on you in the practice. This contains terms so that you have guidelines for which to fire a patient, an employee, so that they know what the rules are. If they fail to show up to the practice without notice or without permission, 2 or more times, that's a reason to terminate them. So it gives you some protection to be able to terminate when somebody violates the rules. Ness, I see your face there.
Yes, we have a question actually. Can binding arbitration agreement be presented to patients to sign when they join a practice as a new patient? And can a signed arbitration agreement protect the dentist or practice in case a patient files a lawsuit? The practice that I worked as an associate had one on the Q&A box,
So that's a good question. And the answer is basically yes to all of the above. So binding arbitration agreements are used in dental practices, medical practices, most often in cosmetically oriented practices, because that's where you have, an expectation of, you don't have a disease process, but you have an expectation of aesthetically becoming better. And if you don't, and there's something goes sideways, it's a good kind of thing to have for binding arbitration. So they are enforceable against patients. There's a special form that has to be used under California law. The size of the print is specified. Some of the print has to be in red, and the patient can terminate. I think it's within 48 hours or 36 hours afterwards. Is it advantageous? In my opinion, the answer for dentists is no. And that's because arbitrators tend to split the baby. They tend to give the plaintiff something, even though it's not as much as they want. With juries, it's more black and white. So much of the practice of dentistry comes down to the judgment of the practitioner. And if a patient's greedy, they got a weak case, when we go to trial, we win 90, 95, up to 98% of the time in dental malpractice cases. So you tend to, it's kind of like tried and true that not using a binding arbitration agreement in a dental practice, I think, is a better idea. In the medical cases I've had, I've been disappointed with binding arbitration for dermatologists that I've represented. But yet for an eye surgeon, it's been a lifesaver because you put him in front of a jury's going to instantly hate the guy. So binding arbitration works for him. But generally, I don't think it's a good idea. Also check with your malpractice carrier. They may not insure you if you use binding arbitration. They may not. So good question. Okay. So employment manuals, custom tailor that to your practice. You want to have an internal complaint process so that if somebody feels that they are being harassed based on one of the protected categories, gender, religion, sexual preference, any of those kinds of things, if they feel they're being harassed, there is a process that they follow to either have someone in the practice investigate, or if it's a small practice and there isn't an independent person like an office manager who can investigate, then there's a process that says, let the practice owner know, and the practice owner will hire an independent investigator to come into the practice to see if something's going on. And this comes in a lot of times when there's two staff members get into it. And one says that the other used, racial slurs, and files a complaint process, uses the system. You investigate. It's like talking to a couple of kids. What's your side of the story? What's your side of the story? And then you come to a conclusion. If it's, you've heard this person cuss before, you've heard this there's independent verification that somebody uses foul language, and you create a new office policy that says, in the practice, foul language is not going to be tolerated. So there's been a complaint process, you've investigated, you've responded. That's what the law requires. And if you have it in your employment manual and a employee says, I've had enough here, I'm out of here, or you need to fire that other person and you're not going to, so I quit. They haven't gone through the internal complaint process, then that gives us as a defense attorney the ability to defend you on that issue, because they had a process. You wanted them to let you investigate, but they didn't give you the opportunity to do so. So employment manuals are good things to have. You don't want to buy one of them that's got like 1 billion policies, and then you have to, if you get one of those, you got to go through it and get rid of all the stuff that doesn't apply. In some of these pre-manufactured ones, they say, well, there's 10 stages you have to go through before you can fire somebody. You don't want that. Somebody does something bad, they mouth off to you, they mouth off to a patient. You want to fire their ass that day without going through. First give them a no, then send them home with pay, then send them home without pay. So you got to be careful what's in those things. Okay. So wrongful termination, that occurs when you fire somebody because you're telling them, well, we don't have room for you anymore here, we're eliminating the position, but then you immediately hire somebody who's younger for less money for the same position. That's age discrimination. Or you're sexually harassing somebody, or somebody goes on pregnancy leave where they tell you that they're pregnant, then you immediately terminate them. Or while they're still pregnant, the office, they're coming in late, you terminate them. You're going to get a lawsuit over it. You just don't touch pregnant employees. If they're pregnant, you got to grow with the punches. If they have some difficulty during the pregnancy stage, if you have 5 or more employees, you have to give them up to 4 months off without pay, but you do have to continue their insurance benefits. If you want to terminate that person, then wait till they come back after the pregnancy leave, wait for a period of time, properly document it, then you can terminate and you won't get sued. Disability situations, somebody goes out on disability, the law says you have to accommodate, see if you can wait a certain period of time before they come back, have them come back with limitations. You must attempt to accommodate. And if you don't, and you just say, oh my God, this guy's been out forever, you're terminated, you're going to get sued. So those situations where contact your attorney, contact TDIC or your insurance company to see if they'll put you in touch with somebody who can walk you through how to respond to that. Family leave, typically, if it applies at all, is unpaid, and it does not, typically, there's COVID exceptions, but typically does not guarantee that you're going to have your job when you come back. Wage and hour claims, exempt versus non-exempt. That's where, for instance, a hygienist must clock in and clock out, and a hygienist must be paid overtime for his or her services. They can't be placed on a salary and considered non-exempt. Non-exempt is when you don't have to pay them for overtime, or non-exempt is when they don't have to clock in and clock out. The only people who are non-exempt are dental professionals, dentists, or if you have an office manager who spends more than 51% of their time managing, educating, making independent decisions in the office, not billing and handling billing or accounting, but primarily acting as a manager, then they can be exempt. Don't have to clock in, clock out, can work more than 40 hours a week. They're on a salary. So it's either dentists or a true office manager. If you have a hygienist who you say, well, I'll pay $500 a day, and that hygienist is working 9 hours a day, working through lunch, then they're going to sock you when they're done with your job for 3 years worth of overtime and the failure to pay them for meal breaks. And we've seen that over and over again. time accounting issues. You know, you got to get your folks to clock in and clock out. It's pretty much electronic software now. If there are problems, you got to address them. Somebody's not clocking out properly for their meal breaks. You got to bear down on them and make sure they do that. Overtime, the same kind of thing. You got to pay folks for overtime, and if you don't, then you're going to be looking at a lawsuit. So Ness, you got a question?
Yes. How are associate pregnancies usually handled?
So if an associate is a employee, then same kind of thing, up to 4 months of leave, non-paid leave, but insurance benefits if they're being offered to the associates as employees, and they have to be honored. If it's an independent contractor, then there's no obligation to keep the same or similar job open for 4 months. So it only applies to employees in practices of 5 or more employees. It's a really small dental office, then you potentially are exempt from this law, but it's expansive. It looks over a 20-month time period, counts different employees, so you got to be careful of that. Okay. Meal and rest periods. So for every 4 hours worked, an employee is entitled to a 10-minute voluntary break. They don't have to take it. They don't clock in and clock out, but they need to be offered that break. If you're in a practice where that schedule's so tight that the assistants can't get that 10-minute break, then you're potentially looking at a lawsuit for that. But the 10-minute breaks are typically the weakest claims of a wage and hour claim. Meal periods, for every 5 hours worked, you got to give them a half-hour non-paid break or longer. You got to make sure they clock out and they clock back in, so you have proof, evidence that you are complying with the law. Same thing with overtime. If there's a labor commissioner action filed against you, or you get a letter from an attorney claiming wage and hour violations, the law puts the emphasis on you, the burden on you, to show the time cards to prove that they've been validly paid. If you don't have time cards, you're going to lose. And just some of the crazy penalties, there are wage statement violations. So when you provide a wage statement to your employee, and you know, Paychecks and all the different companies do that, if you're doing it on your own, the stub that shows the deductions from the paycheck, that's got to have your name and address. So the check has your name and address, and the pay stub has to have your name and address and phone number. If it doesn't have your name, address, and phone number, it's a $100 per paycheck violation. Crazy stuff, but that stuff's out there. So by making yourself bulletproof is making sure everybody clocks in, clocks out, they're paid for overtime. If they're hogging the overtime, then you got to take action against them so they stop spending time overtime. You got to police them. If they're making mistakes on their time cards, you got to make sure they fix those mistakes. Otherwise, you're going to pay for it. Waiting time penalties, we've already talked about. Bounty hunter laws. For instance, if you have a alternative work week allows you to have your employees work more than 8 hours a day, say 4 10-hour days, as long as they are being paid for 4 10-hour days, then you don't owe them 2 hours overtime for those 4 days because they voted for it, they're in favor of it, you've registered with the Department of Industrial Relations. If you've screwed up on that process, like a case that we had that drove a guy into bankruptcy, then one employee can turn you over to the Employment Development Department or Labor Commissioner, file a claim, and claims will be filed for all of the other employees. And depending upon how much money is collected for all of the employees in the practice, the person who started it, the employee who started it, gets paid a percentage of the fines and penalties leveled against the practice owner. So those kinds of laws are out there too. Okay, steps to protect your practice, written employment agreements for the staff members, written employment manuals that are a contract between your practice and the employees. See if you can get employment practices liability insurance that covers wrongful termination, sexual harassment, you fired me for the wrong reason kind of lawsuit. Does not cover, typically does not cover wage and hour. You didn't pay me overtime. That's different, not covered by insurance. Statutory posters and handouts. When you hire somebody, you've got to hand out, I think it's six statutory pamphlets and give them forms that are specific to the employment. We do that kind of stuff. Other attorneys do as well. California Chamber of Commerce, you can join them. They're a great company or a great organization to keep you posted on the changes. You can get your posters from them. I think dental societies sometimes sell those. And depending upon your type of membership with the Chamber of Commerce, you can call them for advice. I know TDIC offers that service as well. TDIC will put you in touch with one of their attorneys like us for a free, I don't know if it's 15-minute or half-hour consultation to walk you through some of these difficult issues. So that's the spiel on employment law. You know, we already talked about legal entities for your practice, and we're running out of time, and I like to be on time. So, you know, corporations, partnerships, sole proprietorships, all the legal entities, you cannot have an LLC, say limited liability company, or an LLP, limited liability partnership. They cannot own dental practices in California. They can in the rest of the country, but not in California. So space sharing agreements, that's where you may go into a practice, established practice, rent a chair. Those are kind of specialty agreements. I've got a checklist for that. If you're interested in it, I'd be happy to share that with you. And that being said, I think we're at the end of our journey today, and you guys I should congratulate you all on passing Business and Employment Law 101 for dentists. You've done a good job tonight, and I can tell by the looks of your faces, you guys are satisfied, so that makes me happy. So with that, I'm going to stop sharing and turn it back over to you, Ness.
All right. Thank you so much, Mr. Goldman. Now I'm going to read a few questions posted in the Q&A box. If we run out of time, we will capture all questions, answer them, and send to you at a later date. I think we have one in the box right here. As an orthodontist, if I decide to leave my associate position and there are patients that have extraction spaces still open, are these patients the responsibility of the practice owners? Will I be liable for quote, patient abandonment in regards to any patients that are in mid-treatment?
Good question, tough question. So number one is you want to take a look at the contract with the practice owner. Typically, it says that the practice owner is responsible for ensuring that the patient's care is continued after the associate leaves the practice. If it's not in the agreement, then there should be discussion between you, the orthodontist, and the practice owner to make it very clear that unless the practice owner is willing to let that patient follow you to a new location, or that may not be possible, that it's the practice owner's responsibility to provide for ongoing care for that patient. So that's on the part of communication with the practice owner, setting the practice owner up to shoulder that responsibility. In the patient record, you should make it very clear as to the status of that patient when you have left, so that there's a description, ceasing care or status of the patient as of this appointment. These are the measurements. This is where they are. This is the work they need to do, and educate the patient. Say, you know what? Here's my phone number. If you have problems, I don't care what the practice owner tells you. If you have problems, let me know, because you have established a doctor-patient relationship. And if the practice owner doesn't ensure that they are being covered, then you do have a right to send them off to another orthodontist for care. And you can involve your malpractice carrier if necessary. They'll probably put you in touch with an attorney who will help you walk you through that process. Fortunately, we don't see that very often, but it does pop up from time to time. So once again, bring it back to that contract when you first enter into the agreement. Put in some wording that makes it real clear that if you as an associate are no longer there, that practice owner is responsible for continuing care of the patient, that the associate is not.
I think we have another question here. A patient is accusing a practice owner that they received COVID by coming into the office. Is there a case there?
Well, I haven't heard of that. That'd be interesting. I have not heard of that. And the difficulty in proving that that case is, you know, how do you prove it? How do you prove that they got COVID at the dental office and not, you know, at the 7-Eleven that they stopped at to get a bag of chips on the way there, or the gas station? So number one is your malpractice carrier would cover you for it. Number two, a practice owner, there are some limited immunities for COVID transmission for what's the term? The necessary companies that had to stay open during COVID, essential companies, and dental practices fell within that definition. So if an attorney's handling that case for that patient, they got an uphill battle. If it's just a patient, I kind of laugh at it and say, I'm going to check some legal grenades at you and make it go away.
Interesting. Let's see. There's another question here. Lab fees for a patient's treatment, who is responsible? Is it solely the practice owner, or is it the associate that's treating them?
Well, the lab fees, I would imagine, are being, the lab agreement is with the practice owner, who pays, whether the associate is going to be, whether compensation to the associate has lab fees deducted from it comes down to the agreement the associate has with the practice. Very often the compensation is, you know, 30% of collections plus 1/2 the lab fee. So whatever money is going to be paid to the associate, 1/2 of the cost of the lab is deducted from it. But associates never have independent agreements with labs where they're liable to the labs. The practice owner always is.
I think we have another question here. What are the most common mistakes younger dentists make when leaving an associate or purchasing a practice?
Leaving an associateship and moving on to purchase a practice, I guess. Is that the question?
I believe so. Yes.
Okay. Okay.
Reconfirmation there.
Well, it's so you want to take a careful look at your associate agreement to make sure that there aren't liquidated damages provisions, and there aren't anti-solicitation provisions that could trip you up in the process of buying your practice if it's within the same community. Some contracts of sale, I mean, some associate agreements have covenants not to compete in them. And they say, if you do compete in this community, then it's a $100,000 penalty. Well, you know, if you're going to be buying a practice in that community, that you may be getting a letter from an attorney saying you're in breach of the contract because you're practicing within the community, and you're going to need to hire an attorney that fires back a contract that says, hey, based on this Business and Professions Code section, that's illegal. And the doctor has a right to practice in this community. Doctor has not solicited any of the patients and only intends to practice in the community for the patients that he or she's purchased. So simple answer, take a look at your associate agreement, anticipate potential problems along the way. Don't be overly aggressive in soliciting patients that you're leaving behind. You're going to have a website, you're going to have a LinkedIn page. they have a right to find you, and nobody can stop that. You have a right to advertise. You just don't want to target the advertising to the patients of record of that practice. So when the problems we see are with these liquidated damages provisions for terminating early or accusations of solicitations, usually a responsive letter from me back at the attorney for the other practice takes care of the problem, and the buyer of the practice can go about making sure the bills are paid.
I think we have another question here. In the event where a procedure goes wrong, such as an extraction or a root canal, would a specialty referral disprove malpractice?
Well, specialty, I'm assuming the specialty referral comes after the botched job. And that's the beauty of specialists. If you have a good team of specialists, they typically help you out. You leave a root tip when you do an extraction. You know, you start a root canal and you get in over your head and you refer. Typically, your specialist is going to say, you know, I see these on a daily basis, and I'm here to help you out. I'm sure Dr. So-and-so did as good a job as they can. So typically, that is what happens on a day-to-day basis. But you also want to really treat your specialist well. If they're going to be kind of covering for you like they do, throw them some bones once in a while. Throw them some easy cases, not just your difficult cases. Take them out to lunch. Ask them what advice they have for you. If you keep starting root canals and separating instruments and sending it to them, sooner or later, your specialist is going to say, hey, this is the 10th one I've seen. I'm starting to get pissed off, and I'm not going to cover for you anymore. So it means you're hogging too many, or you're not doing things right. So generally, getting to know your specialist, trusting your specialist, they're going to cover for you, and that's going to go a long way. And if you can keep that patient in your specialty group, your referral group, doesn't go to somebody you don't know, the chances are you're not going to have a malpractice case. They go to somebody you don't know, and they're going to say, oh my God, who did this to you? Then you got problems.
Interesting. I think there's one other question here. This question's asking, what are the most common legal situations you see for new dentists, and they define new dentist within 5 years of graduating?
Pretty much anything that is over the younger dentist experience comfort level. And it usually occurs when they're in an associateship and they're being asked to do things they're just not real comfortable doing. So root canals, and implant placement, if they're doing that. Those are typically the problems, or more extensive restorations where vertical dimension might be involved, more than 1, 2, or 3 teeth, where you've got quite a bit going on. Veneers are always a problem, facial veneers for the anterior teeth. Patient satisfaction is always a problem, and dealing with patients' expectations, bringing their expectations down a little bit, making them understand that dentistry isn't perfect and they may need to work with you on these things. Put veneers on your teeth. They can sometimes pop off. If they pop off, come on back in, we'll take care of you. They sometimes look different from the rest of your teeth. We're only going to be doing 4. So we want to make sure that aesthetically you're happy with what I'm putting on your teeth before I cement it on. So that's communication, and that's kind of seizing up your patient. Another quick example, there was a doctor who was associated with TDIC for a long time, CDA, really neat, older gentleman, and patients would come to him wanting dentures, to replace his dentures. And he'd start off by saying, oh my God, it's like you're wearing an old comfortable shoe, and now you want me to put a new shoe in your mouth. You're not going to be happy with it. And they, please doc, you got to do it. You got to do it. Well, listen, if you're willing to work with me and you understand that it's going to take some time for you to get used to this, if you're willing to work with me, we can go ahead and do that. So you're dealing with the patient's expectations. And there's a lesson to learn there. or you buy a dental practice and it's slightly off topic, but you buy a dental practice and you start treatment planning a whole bunch of treatment that the seller, the old fart hadn't seen, or you're upgrading, amalgam fillings to composite fillings. You got to be real easy about the way you sell that or present that to patients. Once again, dealing with their expectations so that they're sold, they buy in, and they like the way that you're treating them and talking to them. And typically, once you've got that confidence, then you're in good shape. So if something goes a little sideways, they heard about it ahead of time, they bought into the program and say, okay, hey, I'm sure you're going to take care of me, doctor. Let's do whatever needs to be done.
Cool. Just see. Just checking if there's any more questions out there. Let's see. Just check here. All right, I think that's it actually. I guess on that note, thank you everyone for joining us, and we hope you found the information very helpful. This meeting is recorded and it will be emailed and posted on our SMCDS Facebook page. Everyone stay safe and enjoy the rest of your evening. All right, thank you.
Hey, thank you so much. And if anybody has any questions, I think my email address was there on the last page. Feel free to shoot me an email. I'll be happy to answer your questions. And Ness and Nakia, thanks so much for inviting me tonight to do the presentation.
Oh, our pleasure. And thank you so much, Mr. Goldman. Appreciate, this was very informative and gave me a lot to think about actually.
Good deal. You guys take care.
Okay. All right. Have a good night, everyone.
Bye-bye now.